Welcome to this business tax roundup for this month. My name is Dean Wootten. First up, let's look at ATED and the filing of these annual returns, annual tax and enveloped dwelling returns. And this case concerned D&G Thames Ditton Limited. Now, on 10th of October 2014, D&G Thames Ditton Limited bought a property for £650,000. Now, that will fall within the ATED system. So property over £500,000, residential property, and that is reportable via the ATED system. Now, the annual return for the year ended 31st of March 19 was due in on the 30th of April 18, within 30 days of the start of the year. Now, they actually filed a relief declaration return on the 21st of March 19. Now, that was 325 days late, but there was no tax to pay. So some might think, what's the problem? But HMRC issued penalty assessments in respect of the late filing. Now, the 9th of December 19, automatic £100 fixed penalty for the initial failure. On the 23rd of January 20, daily penalties for return 3 months late, £900. And on the 23rd of January 20 again, the automatic £300 fixed penalty for filing over 6 months late. Now, D&G Thames Ditton Limited appealed against these penalties. There's no tax to pay, and they were unaware of their obligation to file an ATED return. So what are the first two, I think? Both the £100 and the £300 automatic penalties were valid. They are filing penalties, and the return wasn't filed. And the company had not shown a reasonable excuse for their late filing. For the daily penalties to be valid, then paragraph 41C of Schedule 55, Finance Act 09, states that HMRC must give prior notice to the taxpayer and specify the date from which the penalty will be payable. Now, notice of the daily penalties were not given until January 20, so after the period to which they were trying to levy penalties for, and that goes against Schedule 55, notice prior to the period in question. So, unfortunately for HMRC, that didn't stick. So notice has been given retrospectively. You can't do that with daily penalties, and therefore the daily penalties were cancelled. So at least something. But the taxpayers still got a fine, not sending in a return on time, even though there was no tax to pay. So let's have a quick look at the off-payroll working rules. We're covering these in depth next month, just before they actually do come in. But just a quick note on something they've just announced. Now, from the 6th of April 21, the rules are extending, i.e. the public sector rules, are extending to medium and large-sized private sector organisations. Now, HMRC's IR35 compliance strategy is explained, and HMRC issued briefing supporting organisations to comply with changes to the off-payroll working rules. So there is guidance available. Now, they have confirmed that it will adopt a light touch approach to penalties. There can be no penalty for inaccuracies relating to off-payroll working rules in the first 12 months, unless there is evidence of deliberate non-compliance. So we're not completely off the hook, but if there's a marginal case, for argument's sake, then do the rules apply, do they not apply, then it's unlikely that HMRC would take issue with that in the first 12 months. Now, HMRC will act if they believe contractors are adopting artificial, contrived arrangements. I'll be very sceptical about plans to get round these new private sector rules. Now, they also usefully state, and this is quite important, I think, I've had this question quite a lot from practitioners. Now, HMRC will not use information acquired under the new off-payroll working rules to open compliance inquiries before 21/22 unless fraud or criminal behaviour is suspected. And I think that's quite an important announcement because for years we've not treated our clients as caught by IR35. From April 21, it's no longer our decision, and somebody else is making that decision, i.e. the end user. If they believe I'm caught, or my client's caught, they're going to put me on their payroll. Now, that does not automatically mean that they're going to go back, HMRC, and open up prior years and say, well, actually, you should have been IR35 for those years as well. That doesn't seem to be their intent. It's almost like, well, if you're complying from April 21, that's good enough. Let's go forward. So that's quite an important announcement there. Well, let's look at a case concerning underdeclared income. Now, this was Mark Turno, taxi driver, and he was within the self-assessment system since about February 06. Now, following a meeting in June 12, Mark Turner agreed he'd provide HMRC with his business records but he failed to do so, despite information notices being issued. Now, based on information provided by clients of Mr. Turner, there was a corporate body that provided information, account customer, and a local council that provided information. They raised discovery assessments, increasing net profits from 10,000 to 23,000 in 9-10, from 5,000 to 26,000 in 10-11, and then from 3,000 to 20,000 in 11-12. So they obviously thought there was quite a lot of undeclared income. Now, the expenses allowed was just set at 37% of turnover. It was just a national trend, so there's no records for that. Now, HMRC invited Mr. Turner to make a late appeal, which he did do in November 17. Now, the Tribunal accepted HMRC's income figures for contract work. They thought the parcel income work was a bit high, so they reduced that on the basis that he was sharing that with somebody else. And they added in some cash income. I don't believe cash income was significant in this particular case, this driver's case. It's very much account customers with the council, etc. Now, the expenses, they were contentious, but the information provided to the NES unit did support higher numbers than 37%. This guy needed help, so he went to the NES unit, and he's providing them with the information. So the first tier were happy that the information he's providing did show the NES unit that expenses were higher than HMRC would allow. So they did allow slightly more expenses. The Tribunal then directed HMRC to adjust the assessments to reflect these revised figures. So I'm not sure how much change he's seeing out of those higher numbers. He's definitely going to have a unrecorded income assessment and presumably penalties, etc. But it was the lack of information he gave. Lack of information, HMRC then went for information provided by other parties. And that's what they based their discovery assessments on. It almost forced his hand to come forward and then just agree a final figure, which he then eventually did. Quick look at an R&D case. Now, HMRC questioned a 300,000 R&D claim. Now, a report was submitted that supported the quantum of the claim, but it was a little bit short in how the projects met the definition of R&D, so blue sky, even innovative, etc., breaking new ground, that type of thing. Now, firstly, the Tribunal was satisfied that there was a methodology behind the claims, but not convinced that the projects were resolving uncertainty in science and technology. Now, if you cannot prove that the projects qualify as R&D in the first instance, then the quantum of the claim is irrelevant. You have to focus on the nature of the project first. If you're happy that you've got something that meets the definition of R&D, then it's worth putting the effort in to quantify that claim. If you're not convinced, then you've got to ask yourself the question, well, if I'm not convinced, will HMRC be convinced? So this was one of these cases where you can see how the numbers were made up, and that was quite clear. But it's a project. Did the project break new ground? That's what this claim fell down on. We've got a bit of VAT moving recently, so we'll pick up some VAT points. Now, first is the VAT deferrals that I'm sure many clients have done. Now, the VAT deferred was between the 20th of March 20 and the end of June 20. So it's essentially your February, March, April 20 quarters. So many businesses were deferred their VAT payments, and it's effectively just cancelling your direct debit and obviously reinstating it for the next quarter. Now, those returns the payments that were deferred, they were due to fall payable on the 31st of March 21. Now, HMRC a while back announced a further deferral of the amounts that were falling due on the 31st of March 21, i.e. the February, March or April 20 quarters. Now, businesses can now opt to pay by instalments under the VAT deferral new payment scheme. Now, they must be up to date with their returns. They can join between the 23rd of February 21 and the 21st of June 21, inclusive, and they must join themselves. The agent cannot do it for them. It's a bit like the deferral for income tax and CGT on the 31st of January 21. The taxpayer had to do that. You as an agent couldn't do that. It's the same with the VAT. Now, taxpayers can choose the number of monthly instalments up to a maximum of 11, and it does depend when you join the scheme. So it's 11 if you join by 19th of March 21, 10 if you join by 21st of April 21. I'm imagining most people will be joining in February and spreading their February, March, April 20 amounts due over 11 instalments. These VAT deferrals, they are interest-free, not like the 31 January income tax and CGT deferrals. Yeah, there's interest charged on that. But the VAT further deferrals, the VAT instalment system, that is interest-free. The first instalment is going to be payable on joining the scheme, and after that, direct debit. They did publish a little bit on errors in deferred returns. If a business has made an error in returns covered by the deferral period, they should complete the Form 652, as they normally do, and send it to the error correction team. Any extra VAT payable must be paid by March 21, unless you agree for it to be added to the deferred balance on joining the VAT deferral payment scheme. So if you do find an error on the February, March or April 20 returns, and you find it by very soon, so in the next few weeks, so I'm recording this towards the end of February, then correct it via the 652, and then the payment of it can be part of the instalment system. But I think the golden rule on this is just come clean, talk to HMRC, see what you can get done on this error. Obviously, if the error is small enough, then you could put it through the next VAT return, and that would be under the greater of £10,000 or 1% of box 6. But then obviously that's triggering an earlier payment of it. So if you wanted to defer the payment of it, you can, but there's a specific way of doing that, as we've just spoken about. Right, quite an important reversal in the News Corp case. Now, were digital newspapers zero-rated newspapers? Now, that's under Item 2, Group 3 of Schedule 8, VAT Act 94. Now, this was a case concerning digital editions of the Times, Sunday Times and The Sun. Now, the Upper Tribunal had ruled they should be zero-rated because when the VAT law came in, digital editions didn't exist. And they thought because they did the same thing, that they should also be zero-rated. HMRC have never accepted that. Now, the Court of Appeal has now reversed this decision, and the Court of Appeal is in line with HMRC. As far as the Court of Appeal is concerned, VAT is applied at the standard rate to all supplies unless the legislation states otherwise. So standard rated is the default. Now, language used to identify exceptions, zero ratings, exemptions, etc., indicates a narrow parliamentary intention. As a strict interpretation of the legislation must be applied. New developments, so they must not allow wider policy than the statutory language permitted. So digital versions coming out doesn't magically stretch the wording of the legislation. The Upper Tribunal were wrong to conclude that the legislation's aim was to promote literacy, dissemination of knowledge, etc. Now, when enacted, it was intended that only tangible matter be included within Group 3. So including music in printed form and not audio recordings. So newspapers in Item 2, Group 3 could not be read as including intangible digital news services that came along later. So the rule that did change on the 1st of May 20, because they do now allow it, specifically from May 20, so now you can have digital versions, but that's because they changed the law from the May 20. But you cannot have it before that. Before that, the law was the law, and it only covered paper-based versions. There's a lot of protective claims gone in, waiting on this decision. Unfortunately, they'll now be refused based on this Court of Appeal decision. But from May 20, they can be zero-rated because the law has been changed from that date, but not retrospectively. Let's look at quite a popular area, and this concerns the education exemption when taught or when subjects ordinarily taught in school or universities are taught by sole traders or partnerships. They can be within the education exemption. Now, this concerned Anna Cook, and she ran a Sorok dancing class for the public under a franchise agreement. Now, she argued that she was supplying private tuition in a subject ordinarily taught in school, and as such, it was exempt because she was a sole trader, i.e. acting independently of an employer. Now, the first tier thought that Sarok dancing was just a form of dance, and as dance was taught in schools or university, then she was within the provisions. Now, the upper tribunal have changed that. They thought Sarok dancing was a specific style of dance, and as such could not be treated as the generic subject dance, which is ordinarily taught in school. So as far as the upper tribunal is concerned, specific styles of dance, Sarok, jive, salsa, say, belly dancing is a previous case that went against the taxpayer. They're all specific forms of dance, and they can't fall within the general rule subjects ordinarily taught in school or university. So unfortunately, Anna Cook has lost this case in the upper tribunal. Now, this will be problematic, I'm sure, because this is a late registration case. And remember, there's no 4-year cap on late registrations. Let's look at a case concerning state-funded education. Quite an important case if you've got clients in this sector. And it's the Colchester Institute Corporation. Now, the Institute provides education and vocational training to over 11,000 students. Now, in 2008, the Institute undertook a building project. Now, their funding, or their training, was funded by a relevant body, and is not regarded as a business activity. Now, as such, Lennart's was in point. Now, Lennart's is full VAT recovery up front, and then you almost like feed back the non-business element via an output tax charge over an extended period of time. Now, you can't do that today. Obviously, they've stopped Lennart's for this type of thing, but this is going back quite a way. Now, in 2014, the Institute argued that its training was a business activity and was therefore exempt. They claimed a repayment of the output tax accounted for in the previous 4 years, and they did not want to net off the input tax claimed back in 2008 because it was outside the 4-year cap. HMRC denied the claim, stating the provision of training did not amount to the making of supplies for consideration. It was a non-business activity, as the output tax was correctly accounted for via the deemed supply under Lennart's. Alternatively, Section 81(3) Big A, VAT Act 94 applied, overruling the 4-year cap, and the initial input tax should be set against the reclaimed deemed output VAT. Now, first-tier tribunal. Institute's provisions of education was a non-business activity, and they dismissed the appeal. As far as the first tier concerned, it was non-business. Lennart's was in point. Now, this went up to the upper tribunal. The upper tribunal acknowledged that state funding was not specific to any particular course. Not every student would necessarily benefit from the funding. However, there was a link between the funding and the provision of education. So there was a supply of education for third-party consideration. The Institute was making exempt supplies of education. They're entitled to reclaim the output tax previously accounted for under Lennart's because there was no non-business use. Now, that looks as though they've won, but unfortunately, the upper tribunal then referred to the decision in Birmingham Hippodrome 2014. Now, Section 81(3) Big A allows all of the consequences of a mistake to be taken into account. The Lennart's principle had been incorrectly applied as there was no non-business supplies. The deemed output tax should be repaid, but then so should the input tax from more than 4 years ago, because obviously some of the asset relates to exempt activities. So therefore, we've got to look at it in the round, so to speak. So yes, a victory, but not really, because of Section 81(3) Big A. This is worth knowing. There's a new SME Brexit support fund, providing up to £2,000 for support and training on how to complete customs declarations, how to manage customs processes and use customs software and systems, and specific import and export related aspects, including VAT, excise, and those rather complicated rules of origin. Now, to be eligible for this £2,000 payment, then you must have no more than 500 employees, no more than 100 million turnover, been established in the UK for at least 12 months, or hold AEO status, and has not failed to meet its tax or customs obligation. Now, this fund is intended to support businesses completing declarations internally. So there is £2,000 out there available to claim if you think this fits your clients. Well, last time we have a quick look at the Uber decision. And now the Supreme Court has ruled that Uber drivers have employment rights, holiday pay, employer pension contributions, national minimum wage, etc. But it's important to recognise this is a labour law case. It does not automatically change the tax treatment. It could do, but it doesn't automatically change the tax treatment. Now, will HMRC pursue the case of VAT? Now, the Times was reporting that they were eligible for a silly amount of money because all the income had been reported by the self-employed drivers effectively, and then they pay their cut to Uber. Whereas the Supreme Court is saying actually the drivers are employees, which therefore means that all the income supposedly belongs to Uber. Now, that doesn't necessarily follow because it was a labour law case. But it'd be interesting to see whether HMRC take this point for VAT. It's a lot of money, so they may well fancy their chances. Now also, will they seek to reclassify the self-employed drivers as self-employed? Again, uncertainty. Because don't think Uber automatically means your drivers are employees and should be on the payroll of Uber. Now, maybe we'll see more in the March budget to address this uncertainty. But I think for now, if we are acting for drivers that operate within Uber and we are treating them as self-employed, then at the moment, the time of recording this lecture, I can't see any reason to change that. Because yes, we've had an employment law case out there, but that's employment law. It doesn't automatically extend to tax law. Well, that concludes the business tax roundup for this month. My name's Dean Wootten. Thank you for listening.